Hey, cash flow maximizers. We are now in part 3 of the Indexed Universal Life series. This time we're going to go over my specific policies. I've got 3 of them, one on myself and one on each of my 2 daughters. So if you're interested in seeing what that looks like, I just think this is good information for anybody that's looking at potentially getting an Index Universal Life policy. In my next video, we're going to go over Index Universal Life versus Whole Life. Which one's better, in which circumstances, and why I recommend one over the other in certain circumstances. They definitely serve different purposes, so be sure to check that one out. In part 1 of this series, we talked about the pros and cons of Index Universal Life, the good, the bad, and the ugly. In part 2, we went over policy design and how your policy should be designed to maximize your cash flow. In part 3, we're going to look at how my policies performed over the last year. So stick around.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
Here's an overview of my main policy. So what we're looking at is my current surrender value. My annual premium is $6,070. This is the anticipated planned premium. My MEC limit is a little bit higher than that. It's about $6,661. So what we see here is the annual premium. We can see the total amount that I paid. Since I started this policy December 2018, I started off, I'm going to show you how I made those deposits. But by the end of the first year, I had deposited the full MEC amount of $6,661. When my renewal period came up, I was able to make the full MEC payment in one payment. So now what we see is, even though I'm only 1 year and 1 month into this policy, I've got total premiums paid, $13,323.36. I have a current accumulated value, $12,210, which is about 91.6% of the premiums I've paid so far. Not too shabby, especially when we get into it, and you'll see that because of how I made my payments throughout the first year, I have not been credited yet for all of the interest that I will earn in the first year. So that 91.6% will go up. The surrender value, Index Universal Life policies have surrender charges typically within the first 10 to 15 years. Depends on the carrier. In this case, my policy has a 10-year surrender charge. So in the first year, my surrender charge is about $800. So that's the difference between the accumulated value and the surrender value. Okay. And we see my death benefit here, $176,000. Take a look here. This is my allocated cash value into my index. 11,800 of it goes into the S&P 500 that I've allocated. And then this amount that's in the basic strategy, which earns a 3% interest rate. That is not something that I get to choose. That is the amount set aside to cover the insurance expenses of this policy. So they put everything above those costs into the allocated strategy that I'm working with. Okay, scroll down a little bit because I want to show you a couple of things. Here is all the rider types that came with my policy. I did not pay extra for any of these riders. These are all just part of the policy. But the important one here is this overloan protection rider. You'll remember in part 1, we talked about the importance of the overloan protection rider. So here's how the company describes what the overloan protection rider does. And with this particular company, in order to trigger the overloan protection rider, you have to be at least 75 years of age, and the policy has to have been enforced for 15 years. So we can see it protects a policy from lapsing as a result of the loan amount exceeding the surrender value. There is a fee when the rider is exercised. Limitations apply to exercising the overloan protection rider, and that's the policy has to be in effect for at least 15 years, and you have to be over 75 years of age. But if you recall, this is how we turn this policy into a paid up policy. So if our premiums get too expensive, if we want to stop being charged premiums for this policy, then we want to trigger that overloan protection rider. Okay, so let's go down to this one. Now, here we can see when I made my first payment, when I started this policy, I started with a payment of $1,200, which was what I had available at the time. Now, my planned premium was a lot higher than that, $6,070. But with this type of policy, it's very flexible. You can make those payments at any point throughout the year, and you really don't even have to make them if you don't want to. As long as you make your minimum payment, you're not going to be at risk of these policies lapsing. Here in February, you can see I made my second payment. Threw a big chunk at that, $4,870. That got me up to my anticipated payment each time, which was $6,070. Now, after I did that, I took a look and saw that I had a little bit more room. I could add some more into the policy this year. And so I ended up maxing it out. So we've got dates of 11/26/2018, February 1st, 2019, and May 4th, 2019. Okay. And then I made my renewal payment on the 12th of December. Here you can see the interest that I was credited, and I will show you this on another sheet. But this $86 of interest that I got credited is only based off of this initial $1,200 deposit, because that was the only thing that has gone a full year for me to get credited on. So I will get credited for this one after February 1st in 2020. I will get credited this one after May 4th, 2020. And then when my next policy period runs around, it'll be in December of that year that I will get credited on however much interest I earn on this initial amount and this initial amount. So this and this will have the next crediting period in December of 2020. Now we can see here my eligibility for loans, the maximum amount you can borrow against your policy. It's going to tell me what that is right here. That takes the accumulated cash value minus the surrender charges, and then you prepay your interest on any loans that you take. So whatever minus whatever that prepaid interest is, that's how much cash available I have for a loan. So if my cash value that's available is $11,800 and change, when the prepaid insurance gets added into it, it makes it so that I can actually pull out $11,334. Okay. Now here's something to be aware of. Most of the people on my channel have seen the videos about infinite banking and how we have access to this cash value within about 10 days of starting our policies. IULs can be different. Different insurance carriers can be different. In the case of this company, they don't have any of it available for the first year. So I was not able to take any loans on my policy in the first year. Now I knew that I wasn't anticipating needing to borrow from it in the first year. But that's something that you need to be aware of, because you don't want to sign up for a policy, put a bunch of money into it, and find out that you don't have access to that when you thought you did. So as soon as my first year annual renewal rolled around, those loans became available. And now it's as simple as me putting in a request through the app for this company. let's look at the next slide. Okay, so what we're looking at here, you can see the basic strategy, the interest earned on the basic strategy. This statement that I got shows 11/26/2018 to 11/25/2019. Premium paid $6,661.68. It says the interest that I've earned is only $15.66. That's because this statement was prior to the crediting of interest on the first amount that I put into my S&P 500 strategy. Okay, so we're going to look and see on another sheet where I got credited for that after that first year rolled around on that first deposit. You can see I didn't have any withdrawals. There's no withdrawal charges. You can see the cost of insurance I had for the year. So $40.32 for the $170,000 worth of insurance that I had. Contract expenses, $719.75. Those add up in different ways. You will see that on one of the other sheets as well. So total premiums paid, and then we've got the surrender charge. Now, this part is pretty interesting. If you take a look here, we've got interest. This shows you how they credit the interest. The premium goes in and they separate out 12 months of policy expenses and what they call excess. The excess moves to this bucket, which can then be invested in the indexing strategies. The remaining amount stays here in the basic strategy. That's what we saw up here with our basic strategy where I got paid 3% interest on. That was our 12 months of policy expenses. Now, when they sent this out, you can see you are here. I did not get credited yet because my crediting period was 12/21/2018 to 12/21/2019. So as soon as I hit 12/21/2019, I got any potential interest credit that was available on this chunk of excess premiums that I paid. Make sense? Next slide. Here you can see beginning accumulated value, $0. Here, interest credited. This shows you the basic strategy interest that I got credited throughout the year. Okay. Interest strategies themselves, this was the S&P 500 index I was in. It doesn't show any because this is not during that time period. Okay. But you can see I made a deposit. They received a premium on 12/25/2018. They received another premium on 2/25 and another premium on 5/25/2019. Okay. Premium expense charges. These are the charges that come out from making excess premium payments. So these are like the load fees that we talked about. You've got your accumulated value charge. This ends up being about 0.02% of whatever the accumulated value is over here. Cost of insurance charge. We just went over what that is. This is the cost of annual renewable term insurance for the year. And then we have the other charges. These other charges are defined as the monthly policy fee plus the monthly expense charge per thousand of the original face amount issued, and additional protection benefit amount, if there's any there. Okay, next slide. Here we've got my policy. This is what gets mailed to me at home. So you can see how everything looks. We've got our original face amount. We've got our total death benefit amount, which, as you can see, $12,274. My death benefit went up. That just happens to coincide with my accumulated cash value. So if you ever hear the financial gurus out there, one in particular who likes to complain about life insurance policies not paying you for the amount of money that you have in the policy, they only give you the death benefit. That's simply not true. You can see I started out at $164,000. We've got $12,000 accumulated cash value, and my death benefit went up $12,000. So if I were to pass away, my family would receive the original death benefit plus the accumulated cash value that's grown in this policy. Okay. Next slide. This is what I received after I hit that first crediting period for interest. My initial value is that $1,200 that I paid into the policy minus the 12 months of prepaid insurance expenses. That left me with $734.41, which was considered the excess cash in the policy. So that's what got invested into the S&P 500 point-to-point index. I earned 11.75% during this crediting period, which means I got $86.29 added on to my cash value. All right, next slide. So here we can see exactly how that index strategy point-to-point played out for the year. The original index value on 12/21/2018, 2,416.62. The value on 12/21 when that index period ended, $3,221.22. That's a growth, an actual growth of 33%. The S&P 500 did really well this last year from those two date points. Okay. Now, because I have a cap of 11.75%, I only get 11.75% on however much I had invested during that time period. In this case, we can see that was $734.41. So the earnings for that period, $86.29. My next, if you recall from the earlier slide, my next index crediting period will happen in February of this year. And that's going to be a big chunk because that was when I put over $4,000 into the policy. So the way that the stock market sits right now, I will still earn 11.75% on that amount because between today, which is in January of 2020, between the year ending period then and now, the S&P 500 has gone up 25%. So I'm hoping by next month in February, as long as we're over 11.75%, I will get the full 11.75%. So at this point, I'm pretty confident I'm going to earn 11.75% on this first year's crediting period, which will put another $500 or so into the policy, which is pretty exciting. So I had expense charges this year of just under $800. Now, it's highly likely that I will earn close to that $800 to offset all of those charges that I had in the very first year, which is really exciting. Next year, I will probably have a similar amount of expense charges, but I'm going to have twice as much money available in the policy. So each year, as the policy amount goes up and those expense charges stay relatively stable, I'm going to be able to recoup what we started on and hopefully pass this break-even period pretty quickly within just a few years, to where I will have more cash value available in the policy than I've paid in premiums. All right, next slide. I didn't make a slide of every single policy that we've had, but this is now my daughter's policy, and you can see how hers paid out. She had the same crediting periods. She also earned 11.75%. Now her policy had $344.79 cash value in the index portion, which earned $40.51. Total premiums that I ended up paying into this policy, it was very similar. I think it was $600 was the first payment that I had made for this period. And overall for the year, I think we put in about $2,700 for the year. So I'm excited to see how much interest I get on that next chunk of hers as well. And the last slide, this is my other daughter's policy. Her total premium paid, again, we started with $600 was the first one, but I think overall for the year, we ended up about $2,200 or $2,300 was the total that we put into her policy this year. Yeah, and we were just limited on that based on the same amount of death benefit for both daughters. But because one of them was a little bit older, we were able to put in a little bit more money into her policy before we hit the MEC. Okay, that's it. That's our policies. Stay tuned because I am going to take you along with me as these policies progress. So when I get the next interest credited for the index, I will do a follow-up video and you guys will be able to follow along with me every time we get some more information on these policies. That's it for this video. If you found value in today's video, please hit the like button. Be sure you're subscribed to the channel so that you can follow along. Remember, the next video that I put out will be an index universal life versus whole life, because it's really important that you understand the differences and what situation is best for which product. So we'll see you next time. Now go maximize your cash flow.